Hey everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a fascinating corner of the market, hard to borrow stocks and the mechanics of a potential short squeeze. We'll be focusing on a very specific example that recently popped up on our screeners, short-showing, ticker symbol ZCMD. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight into it. ZCMD, or Zhongchao Inc., is a microcap company in the healthcare information services sector operating primarily in the People's Republic of China. Show ZCMD logo/stock chart with a market capitalization of just $7.03 million. ZCMD provides healthcare information, education, and training services to medical professionals under its endemic brand. They also operate through a segment focused on the sales of patented drugs and patient management services. It's a specialized niche, and one that has caught our attention due to some very interesting data points. What does cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and why should you care? When you short a stock, you're betting that its price will go down. To do this, you borrow shares, sell them, and then hope to buy them back later at a lower price to return to the lender, profiting from the difference. But borrowing shares isn't free. You pay a fee, known as the cost to borrow, or CTB. This fee is expressed as an annualized percentage. When a stock is hard to borrow, it means there's high demand from short sellers but a limited supply of shares available to lend. This scarcity drives the CTB fee sky high. Think of it like a rental car in peak season: high demand, low supply, expensive rental. This fee can sometimes even exceed 100% annualized, indicating extreme pressure on the borrower supply. Why this stock is hard to borrow right now. Now let's apply this to ZCMD. Show data overlay. Our screener flagged ZCMD with an astounding cost to borrow fee of 846.6% annualized. Yes, you heard that right, 846.6%. This is a staggeringly high number, indicating a massive premium for anyone looking to short ZCMD. The estimated float for ZCMD, which is the number of shares available for public trading, is quite small at only 1.1 million shares. When you combine a high demand to short with a very small float and unknown shares currently available to borrow, you get a classic hard to borrow situation. Our internal composite squeeze score for ZCMD currently sits at 47.5 out of 100, which suggests some underlying conditions for potential squeeze are present. However, it's crucial to remember that a high CTB does not guarantee a squeeze. It can also mean that short sellers have strong conviction and are willing to pay a premium to maintain their short positions, believing the stock will ultimately fall. Squeeze mechanics explained. So, what exactly is a short squeeze? Imagine this: a stock has a high CTB because many people are shorting it. Then, for whatever reason, positive news, increased buying volume, or just a small spark, the stock price starts to rise. Show animated chart rising as the price climbs. The short sellers, who are now losing money on their positions, might be forced to buy back shares to limit their losses. This act of buying back shares to cover their shorts creates demand, which pushes the price even higher. This creates a feedback loop, forcing even more short sellers to cover, leading to an accelerated upward price movement. That's the essence of a short squeeze. Dilution risk check. Before getting too excited about squeeze potential, we always perform a dilution risk check. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. For ZCMD, we found good news on this front. Highlight: no recent dilution, no recent dilutive SEC filings such as -1s, -3s, or 424 BS have been identified in the last 90 days. This is important because even if a stock has a high cost to borrow, new share issuance can flood the market with more shares for shorts to cover, with effectively negating or significantly dampening a short squeeze thesis. Recent reverse split watch. Now, something else critical to note about ZCMD: the company executed a 1-for-3 reverse stock split on June 29, which was just 37 days ago. Show text: 1-for-3 reverse split 37 days ago. A reverse split reduces the number of outstanding shares and, in theory, resets the share price higher. For example, if you own 3 shares at $1 each, after a 1-for-3 split, you'd own 1 share at $3. What's interesting for microcap stocks, like ZCMD, is a historical pattern where many tend to see renewed volatility or a price pop within about a month after a reverse split. This isn't a guarantee, and it certainly isn't universal, but it's a pattern we've observed that can add another layer of potential interest or volatility, especially when combined with a hard-to-borrow situation. Once again, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at ZCMD's recent price and volume action. Show price and volume charts today. ZCMD is up 11.32%. Over the last 5 days, it's down 7.81%, and over the last 30 days, it's down 4.7%. What's truly catching our eye is the volume. Today's volume for ZCMD hit 24,975,200 shares. That's a staggering 2.3 times its 30-day average volume of 10,631,787 shares. This surge in volume, especially with the positive price move today, suggests increased attention and activity. When you have a stock with a small float, an extremely high cost to borrow, a recent reverse split that might be entering its historical volatility window, and then you see a significant spike in volume with positive price action, it creates an intriguing scenario. We'd be watching for continued high CTB, further increases in buying volume, positive price momentum, and any signs of shrinking shares available to borrow. So, ZCMD presents a fascinating case study in the world of hard-to-borrow stocks. With its astronomical 846.6% cost to borrow, tiny 1.1 million share float, clean dilution check, and recent reverse split falling within that historically volatile post-split period, it's certainly a stock with a unique setup. Coupled with today's substantial relative volume and price increase, it's a name to keep on your watch list for educational purposes if you're interested in the dynamics of short squeeze potential. Remember, though, every trade has risk, and a high CTB is just one piece of the puzzle. Always approach with caution and thorough due diligence. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments what stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.